All right, let's move from the stock market story to the bond market story, where we keep talking, especially in the United States, about that fiscal cliff. And certainly that was a big focus of discussion after Donald Trump's big, beautiful bill. Is that going to change the appetite for long-term U.S. bonds? Let's ask Dustin Reid. He's VP and Chief Fixed Income Strategist at Mackenzie Investments. Thanks for being with us, Dustin. What do you say? Is it changing the mood on investing long-term in the USA, this fiscal uncertainty?
Hi, John. Thanks very much for having me on the program. Yeah, I think there's a little bit of that happening. I think there is some concern within the bond market about the long-term efficacy of the long end, so to speak, of the U.S. Treasury curve. Some of that's coming over the fiscal story, as you mentioned. And it's not only a U.S. story. I think there's also a bit of a global story happening there. But I also think that there's concerns around the Fed. And I think there's concerns around potentially some parts of inflation underlying in the economy. Obviously, what's happening with tariff-related industries, that could be an issue. And then obviously pressure on the Fed to cut rates when inflation is clearly not coming under control, particularly back to the 2% target. So that's definitely a concern for investors in the fixed income market.
And so what do you think will determine the mood of investors over the long term? Obviously, a lot of investors like the bond market because very simply, you get those reliable yields.
Inflation is the biggest enemy of the bond market, at least particularly the nominal part of the bond market. And if inflation remains high, then that erodes the long-term, impact that investors will get from the bond market, right, from the curve. And so that's an issue. So people in the bond market spend a lot of time watching where inflation's at. And we've had obviously CPI and PPI data out of the U.S. this week, and though the headline and core on both are relatively tame, relatively friendly, when you kind of strip it back a little bit and you look at some of the industries that have been very significantly tariff-related, you are seeing the beginnings, and I would stress the beginnings only, of potentially some significant price increases. And that, I think, has some people worried that there could be some erosion in the long end of the bond market in terms of long-term yields.
And I guess for those who are trying to determine what will be the biggest factors on the inflation side to watch for, and obviously the central banks are watching in the short term the inflation story, what would be the determining factors there, do you think?
Well, I think there's a few things. Obviously, when you look at some of the industries like IT, computers, autos, sports equipment, electronics, furniture, household goods, all those things I think are very, very important to watch. And we've seen not all, but most of those move higher this week in the CPI data. Now, I think investors will be watching to see if that continues to increase going forward. The Fed has clearly, put a marker down and said that we do expect that tariff-related inflation pass-through will happen in the June data, which we just got in July, and the July data that we'll get in August, and maybe even beyond. And so I think the market's looking at that and saying, okay, well, the Fed may have seen some of the beginnings of what it believes will be tariff-related inflation pass-through here. And what does that mean for Fed funds? What does that mean for rates in the U.S., particularly at the short end? Is the Fed going to cut? I mean, I think the July meeting is a non-event, but is the Fed going to cut rates in September? And the market's still pricing a decent amount for September. So if that gets priced out, obviously that has an impact not only for fixed income, but also for FX, for equities, for all cross-asset markets. So the inflation data here over the next few months, I think, is paramount for all asset classes in terms of the directionality of price action. And,
I do wonder, obviously Canada has had a more aggressive rate cutting cycle than the United States. And so that's ultimately something that impacts the yields on Canadian bonds versus U.S. bonds. But Canadians are watching, all the fiscal uncertainty in the U.S. as well. What would you say is the general appetite for U.S. versus Canadian fixed income?
Generally, over the last quarter or two, the appetite has been more for U.S. duration than Canadian duration. And that's something that we've had on in our book, so-called a spread narrowing between U.S. and Canadian yields, whether in particularly the 10 and 30-year space. And it's a trade we continue to have on. So we still think that U.S. duration, as it were, will outperform Canadian duration. We're still obviously awaiting a budget here domestically in Canada. We're looking to see what the budget numbers are going to be like. There was some discussion last week of a $92 billion deficit for the current fiscal year. And if that happens, there probably needs to be additional issuance. But the question, of course, is not only how much, but where it is on the curve in Canada. And Finance has given some guidance, Ministry of Finance has given some guidance that it probably won't be issuing at the very long end, either at 10s or the 30-year space. It's going to be more in the bills and the 2 and 5 year space. So the 10-year space, where a lot of investors look as a benchmark and where we spend a lot of our time, real money spends a lot of its time, may not be as impacted from an issuance perspective. But overall, we continue to be what we would say short duration in Canada, particularly versus the U.S., and prefer U.S. duration here over Canada, particularly on a spread product.